Thank everybody for joining. Appreciate those that are watching this live and on YouTube and listening to this as a podcast. My name is Michael Gayed. I am a member of the ETF think tank at Title Financial Group. We are an advisor that brings ETFs to market. And we do a lot of work with different issuers, different financial advisors, as well as different thought leaders like Mr. Dan Niles, who is the guest for today. This will be a great back and forth with my colleagues, Dan Weisskopf and David Chikansky, with what's going on from a macro perspective, and then on a micro level, talking about various tech themes that Dan's a big fan of. Please, folks, do me a favor as you're watching this. Make sure you click that subscribe button on YouTube and help us grow the channel, because we're doing everything we can to get quality guests and quality content out to you totally for free. With all that said, we will start off with having everybody introduce themselves, and we will go to my friend, my colleague, the professor, Mr. Dan Weisskopf.
Thank you, Michael. Dan Weisskopf here, co-portfolio manager of the blockchain ETF, Biotech. And Dan, really looking forward to a robust conversation. Also lead ETF strategist for the ETF think tank. I'm going to pass it over to David, and then I'll keep going.
Thanks so much. David Chikansky here, fellow portfolio manager within the Title Financial Group, focusing on gig economy, bureau, boss stocks, and as well as inflation fighting stocks. Very excited to have Dan Niles on the show today. Dan, if you could introduce yourself, and we'll kick right off.
Sure. I'm Dan Niles. I'm been the founder and portfolio manager of the Satori Fund, which has been running for almost 20 years, and it's a absolute return strategy focused on the tech sector.
All right, so those that are watching, I encourage you to go to danniles.com. We're going to reference some slides during this video. You're going to see them, but if you want to take a look at the deck at your own leisure, make sure you go to danniles.com. You'll be able to get it there. All right, so I want to start off kind of just big picture, Dan. You had noted in one of those slides that interest rates are still low, right? For all the hemming and hawing, interest rates are still low. Now, I want to do a little bit of a back and forth with you on this, because there is this narrative out there, and it sounds like you might believe this, that rates will still continue to rise. I've seen plenty of people say, well, we should be back to, the late 80s type of level. You're big on technology. I thought technology was supposed to shift the yield curve in such a way that rates on average should be lower the more technology is in our lives. So I want to hear your thoughts on the interaction of historical interest rate levels, where rates should be, and then how the progression of technology impacts what those levels really should ultimately look like.
Sure. So I think, to put things in perspective, if you look at where 10-year Treasury yields are, and as you referenced, Michael, we have a slide on this, and I would argue that slide is probably the most important slide in the entire deck. 10-year Treasury yields average 2.4% over the last 15 years. So you look at that relative to where rates are today, 4.5%, let's say, to 5%, you go, oh my God, that's really high. But if you look at it over 60 years, that number is 5.9%. And that's average. So that's the first point I would make, is by historical standards over a longer period of time, this is nowhere near low. Now, to your point, technology does bring down inflation over time, because you're replacing more expensive labor with cheaper technology, and cheaper technology just keeps getting cheaper every year. Having said that, one of the reasons why I'm in the camp of inflation is going to be higher for longer is sort of the following three things. Number one, you used to have a very steady supply of cheap labor in emerging markets. And as we all know, China had their first shrink in their population in 60 years. People across the planet, including in emerging markets, are just having less babies. And so that cheap supply of labor is gone. Tied to that, we used to outsource to areas like China for cheaper labor. But for geopolitical reasons now, there's a lot of nearshoring. So a fab being built in Arizona, for example, the chips coming out of there are going to cost twice as much, at least, as a chip coming out of TSMC and Taiwan. So offshoring, which has been a trend going on for decades, is now becoming nearshoring. And so that's going to be a problem. And then the final piece of that is cheap energy has been around for decades as well, enabling us to produce things. And I'm a big fan of of environmentally friendly production, but it's a lot more expensive. And so those three things, population, onshoring, and ESG, which have turned the tide on long-term deflationary trends, and they're not going away anytime soon. And so I think that offsets sort of this ongoing deflation caused by technology.
So you mentioned cheap EM labor and specifically China, and obviously from a demographic perspective, I understand where you're coming from. Additionally, China's kind of cost of labor is actually a lot higher than a lot of other places in the world. And actually, I think we actually just hit that inflection point of just as much coming from Mexico as China, if I'm not mistaken, in recent history. The U.S. has also done well because of strong wage growth. We've had more wage growth than most of the developed world. You mentioned in your slides continued spiraled wage growth on the upside. Is that both blue and white collar wage growth? Because I think a lot of people assume there will be like blue collar wage growth, but I don't think a lot of people are anticipating white collar wage growth. So I think a lot of people on this call in the audience would be very happy to hear that, but please give us your thoughts on that.
Sure. I mean, this is probably the second most important slide, so thank you for asking the question. But if you look at it, the most interesting thing about the current period of time and why we haven't had this recession that everybody has been looking for is the slide that if you go to, you'll see that the number of people looking for jobs versus the number of job openings they are out there. There's 40% more job openings out there than people looking. So that in and of itself is going to continue to drive, a stickiness in wages. And I don't think it's any coincidence that we've seen all these strikes in Hollywood or at GM or at the transportation companies. And so as long as that kind of continues, and so I look at that number very closely every month when the JOLTS numbers come out to see, because it's hard to imagine that in a U.S. economy that 70% of it is services based. If the people that provide those services, there's 40% more jobs for those people, that wages are going to see any kind of sustainable low level anytime soon until you have those two lines cross. And that was the most interesting thing coming out of COVID. And if you go back to what we've been saying since really 2021, when those lines crossed very sharply, and we can talk about why, less immigration, more people retiring early, people just, having issues with COVID, et cetera. But however you want to look at it, those lines in terms of unemployed versus people looking for, or the number of jobs available, crossed very quickly. And I think that's why it's going to be an issue. One thing, and I should have brought this up when you asked the prior question, so I just want to touch on it in terms of rates, is one thing we didn't talk about, so I just want to bring it up, is that the other reason why I think rates are going to stay higher for longer is just simple supply and demand. And by that, what I mean is you've got about a $26 trillion size treasury market. The U.S. government was one of the few entities that didn't term out their debt, right? A lot of people went in, refinanced their mortgages, et cetera. But you've got about $7 trillion or so in U.S. Treasury debt that's going to mature over the next year, that's going to need to be refinanced. And in addition to that, you're running a deficit of a couple of trillion over the next year. So you add that together, you get, let's say, 8 to 9 trillion in treasuries. The entire treasury market's only 26 trillion in size. And we've already seen some failed longer tenor bond auctions, like the 30-year that we saw most recently, which then boosted rates. And so I think what you're seeing across the world is people going, wait a minute, U.S. has got more debt than GDP right now, and they're going to run, 7-8% deficits for a long time. I'm not sure that these low rates compensate me for that risk. And so that's something outside of the trends we talked about with technology driving rates down and those three other trends reversing that should keep rates higher, which, I wanted to bring up.
Yeah, along those same lines, what is your view on the dollar? Because it's all interrelated, right?
Yeah, and I think the big mistake we made was weaponizing the dollar when Russia invaded the Ukraine, because what that did was tell every country that was not friendly to us that, gee, if the U.S. is freezing dollars of Russia, then they could do that to us. And specifically, I obviously mean China, because I 100% believe that China at some point in the next, if I were them, I would do it over the next year, because we have a presidential election coming up and we have a war in Israel and a war in the Ukraine going on at the same time. And I found the recent meeting in San Francisco between President Biden and Xi very interesting, because he brought that up again, President Xi did, in terms of, Taiwan and how it was inextricably linked with China. All of those countries, specifically China, are trying to get off the U.S. dollar. And so now you can pay for oil in, Chinese currency. You've got a lot of other people really trying to get off of that dependency. And therefore, to your point, it's hard to imagine that on a relative basis to where it is today, that the dollar doesn't continue to somewhat lose its reserve currency status over time. It doesn't mean that when things are really stressed out, people aren't going to buy yen and dollar, which is what they've always done. But what it means is over some period of time, when you've got that many countries saying, we're not friends to the U.S., we want to get off this dependency, there isn't going to be some push towards a weakening dollar to some degree as a structural issue.
I was going to ask if you had thought that President Xi's trip was kind of like a bond sale, right? Like, please still buy our bonds, right? No, but
to some extent it was, because they're one of the big buyers of U.S. dollars. And somebody out there, and it's not somebody, it's everyone out there. Every time we've tried to sell longer tenor debt, it's gotten pushed back on us. And so sometimes you look at things and you go, that might be a critical turning point in how you need to think about the willingness for the rest of the world to finance our deficits.
That minus 4% day on long-term treasuries was on a 30-year issuance date. So that lines up exactly with that message. So, but given all the geopolitical risks that you're seeing, what is going on with oil, right? Oil's dropping. So like, why is it going down instead of up, given everything going on right now?
Well, this gets us to the question of, why is the stock market going up, right? Sometimes it's funny. I'll have people call me and go, why is the market down? And I'll go, well, there's more sellers than buyers. And I go, no, really, why? And I go, there's more aggressive sellers than buyers. And sometimes there's not a great explanation other than you have money flows doing things that disrupt the market. And one of the things you'll see if you look at my social media posts, it's under @Daniel T. Niles for those of your viewers who are curious. And I put this out before, and I think oil had gotten up to over 100 at the time, and people were calling for $120 oil and et cetera. And I put out a post that said, look, we're actually selling our oil positions or something. And I said, the cure for high oil prices is high oil prices. And so you end up with a lot of speculation on the oil market. And actually, to be perfectly honest, we went in and bought some oil-related securities today, because our view is right now oil is sort of in this band of, it gets close to 70. I'm very interested in oil-related securities of all different types. Oil gets into the 90 to 100 range. And I think that's when I put out my last post on oil. We're more sellers, because at that level, I feel like oil destroys demand. And we actually have a slide in the deck that if you kind of look, you'll see, and this starts back in the 80s. Obviously, everybody knows in the 70s, oil, went crazy and crushed GDP growth. But what you'll see is from the 80s on as well, you can line up spikes in oil with drops in the economy in terms of GDP. And likewise, when, oil drops down, that really helps growth. And people forget that oil sort of feeds into other things like the cost of your eggs and your groceries at the supermarket, because you have to transport all that stuff there, as well as things like tires for your car, because you have to use, oil to manufacture tires and things like that. So oil feeds into a lot more things. To your point in particular, given especially how much we've drained the strategic petroleum reserves where they're down to the lowest levels in like 40 years. I'm much more bullish on oil in the 70s than before. I think a lot of people did get long oil when you had the Israel, the tragedy that happened in Israel, because people thought, well, if Iran gets dragged into this, we could have a repeat of, the 70s, but obviously that didn't happen. So in some ways, when you have these big liquidation type events that happen and you've got this many speculators, people are just getting out at all costs, because you probably remember there were guys calling for $120 of oil again when the Israeli flare-up happened earlier. So I think it's more positioning than it is anything fundamental, especially with oil, closing in near 70.
So Dan, I just did a space with John Molden, and I asked him towards the end, is there anything that people are not, thinking about that you have your focus on? And he was very hyped on this idea that people are underestimating how, from the biotechnology side, there are going to be all kinds of miracle drugs that will extend life. That longevity will be, further out in time. We talk about AI, we talk about technology, but the health side actually should also, one would think, benefit greatly on a go-forward basis. I never hear about that when it comes to the argument about structural inflation and the demographic aspect, because that means if there's more people living longer, and you're seeing the excuses around semaglutide impacting sales and all this stuff, how that maybe impacts that worker inflation slack issue. What are your thoughts on that?
Yeah, so we own actually Eli Lilly and Novo Nordisk. So we own them both. They're core positions for us. But one thing that we did talk about recently is we went in and we bought the Biotech index. And my sort of investment thesis is very simple. No one wants to die. So that's probably a pretty good investment thesis. And so I think with biotech, it's very interesting because of a lot of different issues. The stocks in that sector just gotten destroyed. And unfortunately, as you approach year end, what you see a lot of is people liquidating, positions just because they haven't worked. Nobody wants to show they own anything that didn't work this year, and they all want to show that they own the Magnificent Seven. So you've got this weird thing going on, which I think has also created an interesting opportunity in that space. I think to your point, people are going to end up living longer. I do think these weight loss drugs across the planet are going to, help people live longer, because it reduces all kinds of bad things, heart attacks, etc., that happen. So they're going to live longer. You're going to have an increasing aging of society pulling on the system. That, to your point, is obviously more deflationary in nature, but that's also going to take, it's not like you're going to go from 0 to 100 immediately in terms of extending people's lives. But to your point, it is going to end up extending a little bit. And that's going to be obviously a little bit deflationary, like we've seen in Japan over the course of the last, 40 odd years.
So coming back, and we should move away from the discussion around inflation after this, but I don't think we can end the discussion around inflation if we don't bring in real estate, because to some degree, right, that creates almost a bottom for inflation, right? Inflation, all of a sudden we saw mortgages increase, right? Demand for mortgages increase recently, even with the rates. Talk to us a little bit further about your views on real estate. Can we see real estate collapse as a helping signal?
So that one's the one that I'm spending the most time thinking about. So at least personally, my view was during COVID that real estate prices have gone completely out of control. So for the first time in 30 odd years, I'm a renter, because we liquidated all the properties we had. And given what I just saw a home list for right next door to the one I sold, I'm very glad I did that. So I think there are two things. So if you step back, big picture, what did COVID do? It increased the amount of real estate a ton in the property market. Why is that? Because everybody's home became an office. So commercial real estate, I am incredibly bearish on for a long period of time. And you can see back to, I think, the end of last year, where we were talking about shorting some of the companies related to commercial real estate. Then you obviously saw some bank failures that happened in March. And I think in general, every bank that has come out that has big exposure to commercial real estate has talked about reserving more, trying to get down their exposure to that space. So that's one side of it. And there's a slide that shows some of what you and I are talking about in terms of the housing market. Now, that's the commercial side. If you go to the home side, existing home sales that you and I live in, the demand, the sales number is very, very low, but the supply of homes for sale is incredibly low. And so prices are actually in this weird pattern because obviously commercial real estate and residential real estate are somewhat linked, but you're not living in your office. And so that's the one that I'm spending a lot of time trying to think through, because on the one hand, I think commercial real estate's got a problem for a long time. Now, the good news is it's not as bad as it was a couple of years ago, because now you're having a lot of companies having people come back to the office. So that vacancy rate is starting to shrink. So that should, on the margin, help. But you've also got a lot of properties that need to get refinanced. And now they're going to need to get refinanced at 2 times the rates that they were refinanced the last time at on the commercial real estate side. So I think it's really 2 different worlds. I'm actually really curious to see how this plays out, because the residential market doesn't have a lot of supply, but the commercial real estate market has a ton of supply. And so how that thing plays out over time will be very interesting. But what I would say in the short term is bullish somewhat on residential and very bearish on commercial.
Yeah, I think commercial will very much be based on like what kind of support each local area gets from the city on taxes, et cetera, and rezonings to do creative things. On the residential side, I mean, just as you said, where we all value the square footage in our home more with more use of work from home, it's, that is being seen on a family level, in my perspective, where a lot of the purchasers of home in this low volume market are using high levels of cash, 30, 40, 50, 60% of cash. And this is boomers with cash with higher interest rate savings, using their cash and their family values that home for the next generation more. And it's like that cash has to come from somewhere, and it's likely coming from the boomers. And so, it's just another shift of like value. My fears in residential are around actually areas that are like fully paid off, where, families can't actually afford the insurance and real estate increases. And also the uninsured areas like West Palm Beach. There's a great New York Times article like a month ago that was like, a $4 million house was given like a $180,000 insurance bill, and the whole neighborhood like went for sale like overnight, right? Like, what do you do with that? Like, that's my biggest fear, is actually the fully paid off and the uninsured markets. Because like fully paid off homes are the only ones that like don't have to succumb an asset that is a mortgage. You could take a mortgage, you take the cash, you could buy treasuries, go to sleep. Like, you make 2% a year, right, on an old 30-year mortgage. So I think a lot of that is keeping residential up in weird ways. But what do you see in terms of like building? Because I know there's lots coming to the market, and then like this like cliff. It's like we have lots of supply coming, and then it's disappearing because at these costs, no one's building going forward. So like, what do you see with that?
Yeah, I mean, as I said, like real estate is the one it's really confusing, because on the one hand, nobody can afford to move, because if you sell your house and if you have to get another mortgage, your mortgage is going to be double what you had on your current. So you're stuck. I think where you're going to figure out exactly what kind of shape the residential market is in is when you have the next, big spike in unemployment. Because when people are forced to move for a job, that's when you're probably going to figure out how bad the situation is. Because right now, the good news is nobody wants to sell, so that's keeping supply low. And the buyers, there's a lot less buyers because mortgage rates are so much higher. To the point you guys raised, cash buyers have a huge advantage in that situation. So this is like the most dynamic portion of the market. And so I'm sort of waiting till next year, because as the title of this presentation is, it's Goldilocks meets Three Bears. I think next year you're going to see, because the consumer in general is tapped out, the U.S. is a consumer-led economy, that $2.5 trillion in excess savings, which helped people stay in their homes, even if they weren't making that much money or decided to soft quit, et cetera, that's being burned through right now. And then in addition to that, you've got the people that 25 million borrowers that had student loans that didn't have to pay them back for 3.5 years. They started to pay them back in October. I think all of that comes to roost next year. All of that sapping consumer buying power, all that ultimately starting to show up as the economy continues to slow from the 4.9% rate we saw in Q3 down to, pick a number, 1%, maybe 2% next year, unemployment going up. And that's when I think things get a lot more interesting for the housing market. So I'm more on, as you can tell, I'm more on the bearish side in general, because I do feel like there have been some artificial things holding the market up. And just given my views on commercial real estate, I do think resi's probably got some more issues still in front of it, especially as you hit this wall of refinancings that need to happen in the commercial side. So that's probably, the best way I can think about it. I'm in more of a wait and see mode on some of that.
Weisskopf, your hands up.
Yeah, no, I definitely have. Wanted to switch the discussion around semis, if possible. Obviously, technology.
Love to talk semis.
What's that?
I love to talk semis. That's where I started.
I think it is. So I've viewed semiconductor companies as less cyclical than I think a lot of people seem to think. And I know that's a broad statement because there are different types of semiconductor companies. But when I look at, like, as an example, Taiwan Semi, the fabs are always working, right? There's always demand for what they do. But having said that, they've also seen some softness. What do you account for that?
Well, I would say, first of all, I sort of disagree with your premise. Semis are ridiculously cyclical. And you can look at NVIDIA just as an example of that, where you go back a year and a half ago, revenues went down 30% in 6 months after everybody had been busy thinking, well, data center demand is strong because you got the cloud and all these people going to the cloud and they all need NVIDIA chips to make the cloud run. And then, Amazon and Microsoft and Google, then this was before AI, the ChatGPT stuff, obviously, came out and said, no, we're good. We bought a lot during COVID. And then all of a sudden, NVIDIA revenues went down 30% in 6 months. And I think we can all agree NVIDIA is a great company. So I would say, in general, semis are ridiculously cyclical within tech. Now, it depends company by company, where a memory company like Micron Technology, they're running negative gross margins, not operating, not net, gross. And that's on an operating basis, not with write-downs, but just straight up, they're having negative gross margins. So that space is really bad. Even analog, if you look at it, Texas Instruments, which I think is one of the best analog companies on the planet, they've had negative year-over-year revenues of greater than 10% for 4 quarters in a row. The last time that happened was, I think it was in 2008 and 9, when we had, the big blow up off of the Lehman Brothers crisis. So semis are very cyclical. The stocks, investors have underwritten the fact that, well, things are going to be great for a long time. And I think the risk you're running into right now is the fact that, going back to our discussion on NVIDIA earlier in the podcast, is that China has gone from 20% of demand for a lot of chips, including cap equipment chips, for example, or cap equipment, for example, to more than 40% of demand, because the Chinese are so scared of being cut off from their supply of all kinds of chips that they've been buying like crazy during this period of time. And so you're going to run into this wall at some point next year, because it's not like China's economy is doing great, right? China's economy, since they opened up from COVID, has been very, very disappointing. And so with semis, you've got a lot of cross currents. It's a very much stock pickers market, which I absolutely love. And so I have my favorites in there. Intel is one of them. We bought this stock called Impinj, which was down from like 155 to 50, and where they were going through this massive inventory correction. And so I think you have to really go through it one by one. And this is the weirdest semi-cycle you've ever seen, because it's an asynchronous semi-cycle in the sense that the industries that were tapped out the earliest, so PCs and smartphones is the two biggest end markets for semiconductors. You had, and Apple's a great case in point, right? Apple in fiscal 19, their revenues were down 2% year over year. At the peak of COVID, their revenues were up 54% year over year, because everybody was upgrading, buying Macs, buying smartphones, buying iPads, because you had to work from home. Your kids, like my kids, were going to college. They had to be at home taking classes. So you had to buy equipment for all of this. And so revenues went crazy. You couldn't get enough chips. And then all of a sudden, you could get enough chips, and you went through this ferocious inventory correction. So that went through it first. Then after PCs and smartphones went through the inventory correction in the beginning of this year, now you've seen that broaden out to areas like industrial. And now you're finally starting to see some signs that automotive, you're going through that last. So for me, as an example, we've been looking at Texas Instruments for the first time since before COVID, because I look at the stock and I go, 4 years of down year-over-year revenues of over 10% each. Unless you think that they have gotten stupid all of a sudden and are losing a lot of share, this is just a case of they had enough supply to meet demand, so their orders got cut early, and so now they should be in a position to benefit from it. Intel's another one that, we like this stock right after they had pretty much cut their dividend, after saying they would never cut their dividend. And the reason there being, you brought up TSMC, but if China makes a move on Taiwan, they know the playbook. We're not, by the way, I don't think we're going to do anything if that happens. We'll obviously, say a lot of things, but China knows that if they say, you know what, TSMC, stop shipping chips, which is what we did to Huawei, by the way, starting in 2019, NVIDIA is screwed, AMD is screwed. Intel, by the way, gets chips from TSMC as well. The entire semiconductor industry in the United States is ground to a halt, which basically crushes the tech industry. So companies that are building domestic capacity like Intel, and another reason I'm interested in Texas Instruments, because people hate it because they're spending so much in CapEx, but that CapEx is primarily being spent domestically. Those are very interesting geopolitical hedges to some degree looking forward. So semis is highly complicated is what I would say right now, where some of the chip suppliers I like a lot more than the guys that enable you to actually build the chips, like the cap equipment guys, etc. But it's really a case-by-case basis because of the asynchronous nature of this downturn, and the fact that China, because they don't want to get cut off, is in there, distorting what true end demand actually looks like.
So we have a wall of semiconductor chips and debt issuance to look forward to in the coming years here. So just as a reminder to our watchers, please click the subscribe button below, and also follow our amazing guest here, Dan Niles, at danniles.com. So I'm going to take this a step back and ask you on a more granular level. You're a tech investor, a lifelong tech investor, who is exceptionally bearish and also invests in oil, and also has an absolute return fund in the tech space, which at first thought sounds a little bit like an oxymoron, but obviously, given your expertise here, it clearly is not. So how do all of those things come together?
Well, my background is I have a master's degree in electrical engineering from Stanford. I worked at Digital Equipment Corporation, which I'm guessing 70% of your viewers have no idea what that firm is. But that's the beauty of the tech industry. Tech back in the 80s was the place to work. It was Digital Equipment Corporation, AT&T, Bell Labs, IBM. Those were like sort of the pinnacle of the companies that you wanted to go work in. And at this point, people are like, what's AT&T, Bell Labs? What's that? But that's the beauty of tech, is that things get disrupted all the time. when I started in Wall Street, like Nokia had 40% market share. Then Motorola had market share. And then it was RIM that people thought couldn't be displaced. And then finally, there was this thing called the iPhone that showed up in 2007. And so the great thing about tech is that you have these massive disruptions that happen all the time. If you can figure out, and you have a few companies, Microsoft has been dominant in 3 different decades, but it's hard to find one like that. I mean, you can look at Cisco as a great example. The stock is still down a ton from where it was at its peak in 2000 at $70 a share, worth $500 billion. It's nowhere near that even today, 23 years later. And so with tech, you can actually construct a really good portfolio of longs versus shorts, but you actually have to know the technology and the space, and also be willing to go, yeah, this was a great, IBM might have been a great company in the 80s, and digital equipment might have been a great company in the 80s, but there's this new disruptive technology called personal computers that's showing up that might be an issue. And even if you think things like the internet are going to be a big deal, which it was obviously in 2000, it was an even bigger deal in 2002, but 2.5 years later, the NASDAQ had gone down 78%, and you had 4,000 out of 5,000 internet companies go bankrupt. And so I think the beauty of the tech space is you've got to be dispassionate. You've got to look at the data. Fundamentals don't matter for short periods of time, which also creates all kinds of problems. But over the long term, they do. And so you have to learn how to balance all those out. And I think the big thing with being a successful investor is you have to be a great risk manager. And the math is really simple. If you lose 78% of your value in the NASDAQ, it's going to take you a long time to get it back. Or the easy math is, right, if you're down 50%, then you're up 50%, you're not back to zero. You're still down 25% from the highs. So the key is don't lose money. And we have a slide that we talk about that, but that's what we try to do is, last year, even with the market getting slaughtered, we turned a profit. And with NASDAQ down 33%, and then this year, obviously in a very different market, we're also up. And so that's why I kind of talk about my fund as an all-weather fund to some degree. And tech really gives you that opportunity to do it because you have winners turning into losers and losers turning into winners, and it happens all the time.
So you opened the door to a question that maybe is obvious to some. Does that sound like you have an opinion on Cisco, given that they lowered guidance just today?
Opinion. I have an opinion on them. It's a complicated opinion on them. Do I think the company is going to be around for a very long period of time? I do. Do I think they're getting market share taken away from them from people like Arista? Yes. So I view Cisco more as a trading vehicle than something I look at and say, I got to own this for, being a big wealth creator over the next decade. I mean, and that's the way I think about tech stocks. I don't look at a tech stock and say, for example, I publicly talked about this, which is when I bought this company Impinj, and this was a few weeks ago, I put a post out on it, and I said, look, there's very few areas in semiconductors, and even in technology, where you can say, I could see this space growing 25% a year for the next 5 to 10 years. That's not a category I put Cisco in. And also because Cisco is the dominant player in its space, they're getting market share taken from them from other players like an Arista that are more nimble and focused. So now from a trading basis, because I think, sometimes you have great trades that turn into investments and vice versa, and sometimes you take advantage of oversold conditions. I will admit we went in and bought a small position today when the stock was getting hammered because just based on a bunch of different technical metrics we looked at, the stock looked somewhat oversold. But again, that's a trading position. It's a small one. If it, had an oversold bounce, we'd probably get rid of it and move the money into something else because, the fund has what I call high probability trades in it. And then we have our core positions like a Facebook, for example, or an Amazon that will trade around. But it's constructed of different pools of money and different ways to make money is the best way to put it.
I want to pivot a little bit, speaking about high probability. If you think there's a high probability trade in small caps, mid caps broadly, because it doesn't seem like the probability is pretty high that consumers will do all that well. And I know you've got a slide on that when it comes to consumer savings and spending. I have to tell you, I've been on this kick for the last several months. To me, the simplest answer is always the right one. Why is it that small caps are not doing that well? Because they're more tied to the consumer than multinational large caps.
Well, they also have a lot of small banks in there too.
Correct. But although you'd see a similar pattern if you look at retailer stocks, large amount of sideways action. And I've also noted that point that 63% of the Russell 3000 after inflation is actually negative on a year-to-date basis. We know the differential is huge between the mega caps and small caps, but I want to hear your thoughts on consumer. You mentioned the student loan repayments a little bit earlier in the conversation. Is this going to be sort of is there a contrarian trade to bet on the consumer? Oddly enough, because the stock's clearly not.
No, no, I don't think there is, because I think honestly, you're giving way too much credit to the consumer. I mean, I look at Apple and I'm talking about the fundamentals. So let's forget about the stock for a second, then we can bring that in if you want. But Apple has been lowering top line revenue estimates for Apple have been going down every single quarter they've reported this year. They went down after they reported in January. They went down after they reported in April. They went down after they reported in July, and just now in October. They've gone in every single quarter. And this quarter is very interesting because the consensus was for revenue growth of 5% year over year for the December quarter, and they guided to flat. So I think what'll get interesting is because you had 25 million student loan borrowers that didn't have to pay back anything for 3.5 years, having to start to repay in the month of October. And a lot of those are the type of people that Apple counts on as customers. In addition to the fact that you have excess savings, which at their peak, and so what excess savings is, you sort of draw a trend line of this is how much consumers save, this is how much they make, but then you had all this government stimulus. And so if you look at that trend, consumers had about $2.5 trillion more on their balance sheets in the banks than what they normally should have had. That $2.5 trillion is almost gone. And so you put that together, combined with higher interest rate costs and the fact that you're seeing delinquency start to go up. I mean, Walmart obviously reported today, and they talked about pressure that they were seeing in spending in the month of October. And then the high end, you've seen, Gucci or Burberry or whoever, you pick your favorite. The high end is also, interestingly, seeing a slowdown in demand also, which I find interesting given the stock market has done so well this year. So for me, I don't want to, quote unquote, bet on the consumer. I might bet on individual companies where I think the whole, weight loss drug stuff destroying all the consumer companies, I think that's overblown in the short term. That's going to take some time to play out. And so we've actually started, and this is more trading right now, because it's kind of hard to say, well, I want to buy a consumer staples company, but you're also negative on the consumer. But at a certain valuation, you go, that stock or that sector looks kind of interesting, and it's a way to get more defensive growth. So I'm looking at more of the consumer staples companies that have been sort of caught up in the whole, oh my God, people are not going to take in as many calories. And again, that actually started with Walmart CEO making a mention of that, saying, hey, we think the whole weight loss drug stuff is impacting our revenues because they do a lot in food. What I'd honestly like to know is, how does he even know, right? Does he have a survey on all of his customers on whether you're taking weight loss pills or not? I don't think he probably does, but maybe I'm wrong. But the question is, how does he even know? Because you've had a lot of other companies say, no, that's not happening, but you've seen the stocks getting murdered. So that's where I'm more willing to take a contrarian bet on the consumers in the consumer staple space, not in the discretionary consumer space where there's no way you can think that Apple trading now at a 30 PE with negative 1% revenue growth this year and 2% revenue growth last year versus the S&P that's trading at a 21 PE with closer to, I think it's 4% revenue growth this year. There's no way you can think some of these consumer companies are cheap, and Apple's obviously the most important stock in the market just by sheer fact of its size.
I love the refreshing comments on the weight loss drugs, right? They're not like potentially cure-alls for everything, but I want to actually dig a little bit deeper on that, because besides for their effects on the consumer side, the other next leg of this that they're saying is that this is not a weight loss drug. This is a behavior modification drug that just happens to change the behavior of your eating habits, right? First, and then we're going to have it so you can take a shot and like be less addicted to social media, right? Like, how far does this go? You're bullish on these holdings, so like, how far does your bullishness go in this avenue?
Here's what I would say. It amazes me, and this may be just, how I grew up. It was, I immigrated to this country, with my parents, and it's, the typical immigrant story, right? It's 5 people sharing a 1-bedroom, 1-bath apartment, and etc. And my basic thing was, you better work hard, take responsibility for your actions, and you'll get ahead. And nowadays, it feels like a lot of people want to blame other stuff for issues that go wrong, and they're willing to take a pill to try to fix that. And I hate working out. I will tell you that. I like playing sports, which unfortunately I can't do much of anymore with a shredded ankle. But I hate working out, but I do it because, I believe that doing something the all natural way is better. But I don't think that's the way a lot of people are. And so I think if they can take a pill, and there's a whole industry built around this to get around it and to make it easier, they will. And, I take aspirin and I take cold medicine. I take all this other stuff too. And I guess it depends on where you want to be on that continuum. But I think given that it's going to help you not die if you take this medication, that's a good thing. And so I think it's going to be pushed further than any of us probably anticipate. And so that's why I own Lilly and I own Novo Nordisk, because I do think we're going to push this pretty hard. And I do 100% believe that these are going to be the biggest drugs that we've ever seen. And because everybody around the globe will end up taking them, and it will modify your behavior, as all drugs do. And that's true whether it's alcohol or, legalized marijuana, or you pick whatever you want, but it all messes with your mood. So, yeah, I think we're going to have to see how far this gets pushed, because I think it's going to get pushed pretty far, which is why, I own the drug companies that make them.
Dan, we've talked about investing. We've talked about trading. You're a guy who has a lot of conviction in what you do. But we also know you go short. Talk to us a little bit about how you size risk, because at the end of the day, that's what you do best, right? When you put a trade on, how big is it? And I'd love to hear, any specification, 1%, 2% specific names. But anyway, that's the question.
Yeah, I think here's what I would say. I have conviction, but I 100% believe in the saying, it's John Maynard Keynes, which is, when the facts change, or God, I'm butchering this. When the facts change, I change. What do you do, sir? And so for me, I may have a point of view, but if it comes out and it looks like that point of view is wrong, I sell. I don't try to justify it. And the best example I would give is Facebook. So you may remember beginning of last year when they reported, they came out and they mentioned TikTok on their conference call for the first time. Or actually, they mentioned something in their press release. And I saw it and I was like, I'm dead. And I'd been bullish on Facebook coming in. I think the stock and I may get these numbers off, but I think the stock was at, close to 300. It was down already like 15% in the aftermarket. And I just sold, I think it may have been all of it in the aftermarket, or at least a good chunk of it in the aftermarket. And it saved me from getting buried the next day. And then the stock went from like 300 all the way to below 100. And so I think you may have conviction and stuff, but especially in technology where you have new competitors like, who had heard of TikTok, 7 years ago or 8 years ago, right? Nobody. And then all of a sudden it shows up and it's starting to impact everything. You have to be willing to go, yeah, got that wrong. This was a seminal moment. Something changed. I need to change my mind. The good news for us is Facebook was a big moneymaker for us last year. Why? Because at 90, people had gone from being very bullish to saying, oh, they're going to spend all this money on the metaverse. And I remember looking at it saying, well, yeah, but that's just a number. He can come back and change that anytime he wants. And so when people had just given up, thrown in the towel and said, yeah, this is dead, we went in and bought a ton of it in the low 90s. And then, as you remember, they came out 2 weeks after they'd given that guidance for CapEx and changed their mind. And then the stock started to rip. So I'm the guy that is more likely to buy a stock where I go, you know what? It's still a good company, but the chart looks terrible. So I have all these people who trade off of charts, all these machines that trade off of charts that are puking this, but at a certain valuation level, it looks interesting. And so for me, I have a long-term view, but I'm trading the market right in front of me every day. And so I may think that we're still going to go higher between now and the end of the year, but if the next 30-year bond auction comes out and it's a colossal failure, I'm going to change my mind. But within that, I'm probably still going to say, yeah, Amazon, I think, is going to gain share if we go into a recession. I think that'll do well. Meta is probably the best revenue relative to valuation of all the Magnificent Seven. And so there's some core things that I'm going to keep, but I'm always trading around positions. Meta was nowhere near as big today as it was way back when everybody hated it. And so I'm typically the one who's selling it when everybody loves it and vice versa. And, I don't think I'll own NVIDIA into their print coming up next week, for example, because everyone knows it's a massive beat and raise. And at this point, after it was up 10 days in a row, I'm like, that's it. I've had it. I'm out. Because the playing field had changed on it. And so I think for me, it's a portfolio. And I know I'm going to get 40% of my trades wrong, which I think if you talk to most investors and are being honest with you, they'll say, yeah, 40% of the stuff I have, I mess it up somehow. And I think the important thing is to be able to recognize that, get out of it, and then re-engage later if you still think you're fundamentally right, but the market's working against you. Because I'm a big believer if you don't want to fight the tape, investing is hard enough. And so for me, I may have a short position if it goes up. I go, yeah, people aren't seeing it the same way. I'll cover it. I'll wait for it to get to a higher point, and then I'll re-engage at a higher level. So I kind of view myself almost as a risk manager, really, not a portfolio manager, because I think that's the number one thing that can get you into trouble is not managing your risk appropriately and sizing it appropriately. And so that's what we try to do with every position every day, because, you brought up Cisco earlier. I mean, it was down double digits today. And so, these stocks move around a lot, and you want to try to take advantage of them when you get a high probability trade in one way or the other. And we've got some data models and data science stuff that we run in the background to help us identify when we've got several different ones. One at a portfolio level has got over 20 different metrics in there from a technical basis that helps us identify short-term tops and bottoms. Bottoms, it's much better on. And then we've got some single stock data products that we've developed that help us with single stock levels in terms of what's the risk of owning something with this kind of technical setup, because we have some very large positions. And I think that's one thing that needs to be made clear. A lot of fund managers may have 100 positions. We have 20 to 40 positions. at most. And a lot of times we'll have less than that, and we'll have single positions on both the long and the short side that are over 10% of the fund. So if you have a position that's over 10% of your fund, or 15%, it's a lot more critical to manage risk than if you've got 100 positions at 1% each, because no 1% position will kill you. If you have a 15% position and you get that wrong and you manage the risk wrong, that will kill you. And so I think that's important for me to make clear as well in terms of why I do what I do.
Folks, this has been a phenomenal conversation with Mr. Dan Niles. If you don't follow him on X, I encourage you to do so. And of course, check out danniles.com. Please click that subscribe button. We're going to be doing a number of these Get Think Tank shows. Special thanks to my colleagues, Mr. Dan Weiskopf and David Chansky. If anybody has any comments, put it in the comment section below the video that you see here. And hopefully we'll see you all on the next episode of Get Think Tanked. Thank you, Dan. Really appreciate it.
Thank you for having me on. Really appreciate the time.